Okay, in this example, it's going to compare Equity Company to Osmore Company. And the example assumes that the two companies have the same amount of assets and that they experience the same earnings per interest, tax, depreciation, and amortization. So if we look at return on equity, it's used to measure the financial return each firm offers its stockholders. So equity used only common stock and retained earnings in its capital structure. So it has 1 million in equity financing and no debt. Over here, Osmore, its capital structure consists of the 200,000 in owner's equity and 800,000 in debt. So it is highly leveraged. So the debt financing is going to significantly increase Osmore's return on equity compared to equity financing when sales are strong or weak, even though the after-tax earnings are not as noticeably different. See the after-tax earnings? So the moral of this story is if the financial returns of leverage seem too good to be true, then they probably are. So it's important that management really keep a level head and balance the risk and return. So the Dodd-Frank Act, it required the larger firms to hold more equity and less debt. And then in the 2018, there were changes to the U.S. corporate laws that encourage less debt financing and more equity financing. And one thing that I want you to remember about the Dodd-Frank Act is that it did give government more oversight of the financial markets. And so it really placed a limit on what financial strategies firms could have. All right, we're going to skip this and we're going to move on to acquiring and managing current assets. So, managing cash, is it possible to have too much money? In a narrow sense, the firm's cash is going to include the currency and the demand deposits it holds. The most common cash equivalents include commercial paper, U.S. Treasury bills, also known as T-bills, and your money market mutual funds. And the maturity period of most of the Treasury bills are 14, 13, and 26 weeks. And what owners can do is they can sell these T-bills in a secondary market to investors before that they mature. So T-bills are highly liquid. And then your money market mutual funds, they pool funds for many investors and then they use these funds to purchase very safe, highly liquid securities. Small investors usually prefer money market mutual funds. Managing accounts receivable. So accounts receivable are, this is balancing the advantages of offering credit with the costs involved of setting credit terms, establishing credit standards, and deciding on an appropriate collection policy. So if a company allows their customers to buy on credit, it can boost their sales, but it also can create cash flow problems because it delays the receipt of the cash and they may not be able to collect on some of the accounts receivable. So it may turn into bad debt for the company. As far as inventory, firms have to have inventory to operate business. Manufacturing firms look to help inventories to keep the inventory as low as they possibly can. That way that they're buying and selling it more efficiently. You don't want to have a large amount of inventory on hand. You want to have it and sell it as quickly as possible. All right, this last section is on capital budgeting. And capital budgeting is a process that a company uses to evaluate long-term investment proposals. So when you're thinking of capital budgeting, you're budgeting for the long term. And so some of the things that you're looking at when you evaluate for the long term is replacing old machinery and equipment, buying new machinery or equipment, or additional buildings, additional plants. Financial managers are going to use cash flow to judge the benefits of long-term investment proposals to see if they will have enough cash flow to meet the needs of these long-term investments. All right, when we're looking at capital budgeting, we have to look at the time value of money. What this means is a dollar received today, a dollar received now is going to be worth more than a dollar received in the future. So financial managers are going to compare cash flows occurring at different times by converting them into their present values. So present value is the amount of money if invested today at this rate, a given rate of interest called the discount rate, would grow to become some future amount in a specified number of time periods. So what it would take now for that amount to grow to a certain amount in the future. And so it also, I wanted to mention the CD, the certificate of deposit. It is an interest earning deposit. And what it does is it requires money or funds to remain deposited for a fixed amount of time. And you can withdraw that money after the date of when it is matured. But if you withdraw it earlier than that, there will be a penalty. The most common method that financial managers use to evaluate capital budgeting proposals is to compute their net present value. And so looking at this, the risk return trade-off revisited, and general products that have the potential for high returns are usually your riskier project, or they have more risk. Okay, net present value is the sum of the present values of expected future cash flows from an investment minus the cost of that investment. So if a manager is looking at the net present value, usually they're going to approve positive net present value projects, which means that we expect to have more cash flows than from the project than cost from that project. But if we have a negative net present value, meaning the cost of that project outweighs the expected future cash flows from that project, the cost is more, then we're going to reject it. So negative net present value managers are going to reject it. Positive, net present value, managers usually will approve it. Okay, and that's the end of chapter 9.